Hi, I'm Liz Namofsky, host of Finance is Personal. We already explored the ABCs of financial literacy earlier, but there is so much more information to cover, so we decided to record part 2 of financial literacy. Knowing the difference between a registered and non-registered account can make a world of difference if you're concerned with deferring taxes or paying taxes on income or capital gains generated from investments. Now, it's also important to understand which accounts and investments come with fees and how they're charged. Depending on your financial goals and circumstances, you may want to seek professional advice. An investment advisor can help you open an account that's right for you and develop an investment strategy that can help you grow your investments efficiently. Joining me again to talk about part 2 of the ABCs of financial literacy is Jackie Sanz, Chief Compliance Officer at Caldwell Investment Management. Welcome, Jackie. Thank you for coming back again.
Thank you, Liz, for having me.
Okay, so we ran out of time the last time.
Yes.
We had so much to cover, and we decided that we'd do a part 2. So this time we're going to focus on, let's begin with fees, right?
Sure.
There are 2 different types of fees.
That's right. So fees can really be bucketed into sort of transactional or activity fees and account fees. In the transactional fees, really you're looking at fees that you create by virtue of doing a transaction. So often called commissions. When you buy or sell something, you'll be charged a fee.
So that's if you do a trade.
That's correct. The other type, which are account-based fees, these really come up by the type of account and the type of assets that you hold. So for example, if your account is registered, you mentioned taxable and non-taxable accounts, you will have some kind of a registration fee that typically is paid annually. Other types of account fees relate to statements. You may get paper statements versus electronic statements, confirmations, etc. So it's important when you open an account, whoever your dealer firm is, you will get a document. It's called the RDI, which is the relationship disclosure document. In there, they will speak to fees, both transactional fees and account fees. There's one other type of fee. I don't want to call it hidden, but some people label it as hidden, and that relates to a product. They're called embedded fees. The most common are mutual funds. So when you purchase a mutual fund, you will find, if you read the prospectus, a reference to loads or sales charges.
Okay, so let's talk about those, right?
Yes.
So this is part of the transactional
Yes, that's
fee.
correct.
So we've got no load, low load.
And deferred.
Okay, so let's go into that. Let's explain what the no load is.
So no load, which is a bit misleading in terms of the name no load, all that really means is instead of you, the investor, paying your advisor up front, the fund company is paying a commission up front to the investment advisor. But in doing that, you as the investor are committing to hold the mutual fund investment for a period of time. The most common is 3 years.
Right.
And so what happens is if you sell it before the 3 years are up, you have to pay a load, a charge. And that's really, you're returning back to the mutual fund company the fee they fronted for you to the dealer.
To pay the investment advisor.
That is correct.
Okay.
And so that's called low load. So there really is a load, it's just back-ended.
Okay. And what about the no load?
So no load is really, and this is going to sound a bit cheesy, front end with a 0 commission. All that means is you as an investor are not giving to the fund company any amounts for the purposes of them forwarding it to the dealer or your broker. You instead are directly with the broker paying whatever the broker charges. And that goes back to the commissions when I said transactional costs. So it's no load, but it's not really no load. It's just not a load in the mutual fund. You still somehow have to pay your broker.
And what about deferred? Because deferred used to be the type of investment that the investment advisors used for a very, very long time.
Yes.
And then that changed.
Yes.
There are a lot of companies that don't have deferred sales
That's
charges
right.
anymore.
Yes, so deferred sales charges, really all that meant was instead of you paying your dealer upfront, you paid, the fund company, again, would pay the dealer up front, but that period, just like the low load that we talked about, the period of time you need to stay invested in the fund is quite long. Could be 7 years, could be 8 years. And on a sliding scale, if you redeem early or sell those units early, you will have a deferred sales charge. And effectively, you're paying the fund company back for fronting to the dealer the sales charge. Now, most fund companies no longer offer this because there's been some regulatory upheaval with respect to these deferred sales charges, and the expectation is they will be banned. So this is where most fund companies, if you buy today, you really can only get a low load option if you're going to get that sort of deferred. But if you already have some, you need to know where you are on the schedule to know whether you're going to be hit when you sell those units of those funds.
There was also a lot of controversy where you look at the online brokers, and they were charging a load, and did they have to pay back to their clients, or
yes,
how did that work?
So instead of that being a load, that is trailing commissions. So trailing commissions are a way for a mutual fund company to incentivize, if you will, an investor through their advisor, so it's really influencing the advisor to keep the investor invested in that mutual fund. So for the entire life of your investment, unlike the loads, however long you hold it, your fund is paying the advisor, it's called a trailing commission. That's correct. So if you go to a discount broker or a no advice broker, theoretically, that trailer is to give advice.
Right.
If you're not getting advice, but you're paying it through the fund, really that puts the dealer who doesn't offer advice in a tough position, because they're collecting money from your investment, but they're not giving you advice in return. So some dealers pay back that trailer, or many mutual fund companies have created something called Series D. And Series D is a very low trail commission, which is intended to just allow the dealer to cover their costs for, if you remember those account costs, statements, confirmations, and any other items they may mail to you or process for you. And so that's the series option, without getting too complicated, that you would purchase if you were in a discount or non-advising broker.
Okay, well that sums up everything about fees.
It's a lot of fees to worry about.
So Jackie and I will be right back after the break to talk more about part 2 of the ABCs of financial literacy here on Finance is Personal. Welcome back to Finance is Personal. I'm Liz Namofsky, and we're here today with Jackie Sanz, Chief Compliance Officer at Caldwell Investment Management, trying to talk about financial literacy part 2 again. And there's so much information.
Yes, there really is. And it's tough to get your head around it, because it can be very complicated, or it can be very simple. It really depends on what you do.
This is true. So let's keep talking about fees, but this is different than fees. This is exploring tax considerations. And these are things that we have to think about in regards to our investments.
Yes, in fact, taxes, while they're technically not fees, as you said, it really is a cost. Unlike fees that you get hit sort of upfront or at the time of doing something, taxes have an implication later. And maybe people don't think about that until it's time to file your tax return. So kind of like fees, there are 2 types of taxes to think about. There are capital events, which I'll speak to in a moment, and income events. So the difference between them is important because it's a timing matter. Income events, which would mean you received income from your investment, could be a dividend, could be interest, those are taxable or included in the calculation of your taxable income at 100%. And they're included in the year that they're earned. You have no opportunity to defer it or move around when it becomes taxable to you. Capital events, which you alluded to before, capital gains or capital losses, you have a little bit more opportunity there. So they don't get included at 100% in terms of calculation of taxable income, but you also have the ability to either, depending on the type of capital event, take it back a year or go forward or use it in the current year. So you have a little more planning on those costs, but there's no doubt about it, Liz, these are costs associated with investments. Now, the one trick to keep in mind is while we talk about taxes, taxes are dependent on your account. And what I mean by that is you can have a taxable account,
right,
or you can have a non-taxable account.
Right.
And it changes dramatically depending on the type of account that you have.
So I've talked to some clients before,
right,
and they get upset where they haven't sold anything,
right,
yet they still have to pay income tax,
right,
on dividends.
That's right.
That they've received, or mutual fund,
right,
dividends as well.
That's right. So now what's complicated about mutual funds, we talked all about those embedded commissions.
Mutual fund distributions,
right,
not dividends.
That's correct. unless the mutual fund is a corporation, in which case it would be a dividend.
Okay.
But if we take mutual funds that are unit trusts, which are the most common of mutual funds, when they actually give you a distribution, that distribution gets recharacterized, without getting too technical, into one of those two things. So either an income event or a capital event. Sometimes a single distribution can be both. And that's where it gets complicated, because you may only get more units in the fund. You may have subscribed to what's called a DRIP, or a dividend reinvestment plan.
Right.
But all of a sudden you'll get this tax receipt at the end of the year that says you earned $1,000 of interest income and $50 on a capital gain. And you think, what? Where's the dollars? I didn't see it. So it is important to very much understand that your investment, so mutual fund versus, say, stock or bond that we talked about last time, or your account type, will also add yet more costs in the form of taxation. And this is where it gets very complicated, or can get very complicated. It's important to get advice from your advisor on this,
Yes,
or your accountants if you have one.
Okay, so let's talk about the accounts that will generate some sort of a tax consequence,
right,
and then the accounts that don't.
Sure. So I'm using the analogy on everything today as two buckets, but really there are two buckets: taxable and non-taxable, right, types of accounts. So taxable is pretty easy. You put money in. There's no tax benefit to you to put money in, and then you transact. And in those transactions, whatever those transactions generate, whether it's an income event or a capital gain or loss, it's applicable now from a tax perspective. So those are kind of simple to understand. When you look at non-taxable accounts, it starts to get pretty tricky pretty quickly. And that's because no one non-taxable account is the same. So again, sort of two types.
The two bucket show.
Yes, the two bucket show. So some of them, taxable accounts, so I'm thinking TFSA right now.
Which is a tax-free savings account.
That's correct. So those, you put money in that are after-tax dollars. And what that means is putting money in doesn't give you a benefit. But while the money is in the account and you're buying and selling and earning interest, earning dividends or distributions, everything that happens in the account is tax exempt. Nothing is happening there. And then when you take the money out, there's also no tax impact to you. So no benefit going in, no tax consequence coming out. Now, the other type of taxable account, so let's use registered retirement savings plans, RRSPs, you put money in, it's called a contribution. You get a tax benefit for doing that, meaning you get to, and this is important to distinguish a credit from a deduction, you actually get a deduction for the amount you've contributed towards calculating your taxable income. Now, in the account, just like the former type, whatever you do is tax sheltered. So you don't have to worry about gains or income or anything like that. Now, coming out, however, you got a benefit coming in, you are going to get hit coming out.
Right.
And
so you pay taxes on the amount that you take out of your RRSP.
Exactly. Now, there's a bit of a, not a double whammy here, but instead of waiting until the end of the year when you file your tax return to get hit, they will withhold taxes right at the time that you take the money out. And the withholding tax rates change. So if you have a small amount, so 50,000 or less, they only withhold 10%. But 5,000. Sorry, 5,000.
5,000 or less.
That's right. And 5,000 to 15,000, it's 20%. And anything over 15,000, it's 30%. And that withholding tax, you get credit at the end of the year when the taxes owing are calculated, you deduct the amount that's been withheld already at source. But the key is, if you get a benefit going in, you're gonna pay coming out.
It's interesting because a lot of people will use their RRSP for emergency funding, even though you're supposed to have,
Yes.
money set aside for emergencies. If they need a new furnace or they need a new air conditioner or
That's right.
something for the house. I get a lot of phone calls from people saying, what is the tax hit? What is going to happen? And so when you tell them for $5,000, it's 10%, they think, oh, okay, well, that's not that bad.
Right.
Because they always think that, the RRSP is supposed to be there for your retirement.
That's correct.
And they think that they're going to get a big tax hit. But it's really not that bad.
Well, certainly not at the withholding, but remember, anything you take out of an RSP is included in your income.
Right.
If you are in, say, the middle tax bracket in terms of the marginal tax rate, and you take out money, that could bump you up to the higher. So yes, there's only 10% withholding, but perhaps at the end of the year, you will be shocked to discover you are now in the highest tax bracket, and you actually owe 46% on that, and they've only taken off 10.
Right.
You got a lot more you need to pay at the end of the year. So truthfully, if you have these types of emergencies that come up, really you should be using a TFSA.
A tax-free savings account.
That's right, because no benefit in, no cost coming out, and all the gains and stuff in there are tax-free. That's your best vehicle for these types of emergencies, and not an RSP.
So we'll be right back after this break to continue our talk about financial literacy part 2 here on Finances Personal. Welcome back to Finances Personal. I'm Liz Namofsky. Joining me today is Jackie Sanz, Chief Compliance Officer at Caldwell Investment Management. And Jackie, before we went to the break, we were talking about fees and consequences. And I think it's important to talk about the fact that if you over-contribute to any of these accounts, there are consequences.
Absolutely. So we talked about sort of benefits of these non-taxable accounts. There are some serious consequences if you don't stick to the rules. So every type of non-taxable account, TFSA or RSP, which we just spoke about, have rules on how much you can put into them in any given year. If you make a mistake and don't keep track, you essentially what's called over-contribute. Over-contributions have a penalty. If you did not realize you over-contributed and say it's January, next year, next April, when you go and file your tax return, you are not only going to discover that you have an issue, it's 1% on the amount you've over-contributed compounded.
Wow.
So it can add up if you're not paying attention. So it is very important to know your limits of what you can put in, and then of course understand everything we just spoke about in terms of the implications coming out on the other end.
Okay, so let's go deeper into these accounts because, one of the questions that I get asked all the time is, should I invest in an RRSP or a mutual fund? Right? So let's go a little bit deeper into these accounts and what they are, and then the whole over-contributing and fees and everything else. So an RRSP is a registered retirement savings plan.
That's correct.
And that is there to help you, it'll give you income.
Yes.
For the times that you've retired. So
That's
it
right.
gives you a little bit of a supplement so that you can live your life.
That's right.
So why is this account here?
Right.
And what are the consequences to using it earlier?
Right.
And what else do people need to know regarding an RRSP?
Sure.
Because they still don't know. They think that it is an investment.
Right.
So let's talk about the fact that it's just an account.
Yes, so that is absolutely correct. An RRSP is an account type. It's one of those non-taxable account types. It was designed, and its structure about its limits of money going in and how the income is treated when the money comes out was intentionally designed under the Tax Act for incentivizing people to save money not just for retirement, but for way in the future when you don't have any other source of income. Because remember, that money that comes out, it doesn't matter if it was a capital gain, which we already talked about being less than 100%, including an income. It's 100% treated as income, which means it's like having a job. That money has to be taxed as 100% income. You never want to take money out of an RSP if you can avoid it when you're already got a job and you've already earning income, because it will bump you up the tax scale. And what was the purpose? Particularly if your RRSP only had capital events in it, so those things that were taxed normally at less than 100%, if that's the type of income you're generating, and now you're being forced when it comes out to treat it at 100%, and you already make maybe $50,000 a year, I mean, that's not exactly double taxation, but it's the kind of idea where you're getting hit way more. So it's very important that people understand it's an account type, it's purposeful for long-term investing and to a time in your life when you are not earning income, unlike a TFSA.
So I think it's really important to let people know as well, first-time home buyers can actually borrow money from themselves, from their RRSP.
That's right.
And they have to pay it back within 15 years.
That's correct.
But you're paying yourself back and you're borrowing your money.
That's right. And the detriment, if I can call it that, is if you borrow this money, which really just means you get to withdraw it with no tax consequence from your RSP, you have to pay it back, but now you've taken money out and you are losing the opportunity to grow money for the future. So yes, it's very useful, particularly if it's your first home and you don't want the debt, but you need to be able to, as quickly as possible, pay it back. Because although you have 15 years, all the payments that you are making are not going to that benefit up front, the contribution that you get a deduction. You're just paying back a loan, essentially. And you miss those years of accumulation of income. So yes, it's a great program, but again, you need to plan correctly because it could be to your detriment if you don't pay it quickly.
Okay, so tax-free savings accounts, they started in Canada in 2009.
Yes.
And if you were 18 years old or older at the time, you, to this day, can contribute up to $63,500.
Yes, on a cumulative basis, that's correct.
So if you turned 18 a few years ago, then the amount is different for you.
That's correct. So basically, sort of like an RSP, every year there is a set amount that you can contribute. You never lose that contribution. So if you didn't, let's say it's $6,000. If you didn't contribute your $6,000 this year, next year you still have the $6,000 from this year plus whatever the amount is that is permissible next year. So that contribution room is what we call it, carries forward. Now the nice thing about TFSA, totally unlike an RRSP, is let's say you wanted to buy a house and you had that $35,000 in there. You don't need a home buyer's plan. You take the money out of your TFSA. There's no tax consequences at all to you. And not only do you have this year's, in my original example, $6,000 to put in, you can put back that $35,000 that you borrowed, plus this year's $6,000 and whatever next year's and the future year's amounts are, with no impact to you. So again, you really need to think about where you draw your money from and I'm going to call them costs, it's really tax implications, but the consequences of picking those accounts to take that money out. TFSAs were intentionally designed to be more like a bank account, if you will, with a little perk on it. And that's why the contribution amounts every year are much lower than an RRSP, which is intended to be future income when you don't have money.
Okay, so now that you talked about an RRSP, I think it's important to talk about RRIFs.
Yes.
The Registered Retirement Income Fund.
That's right.
And so what happened when you turned 70, the year you turned 71, your RRSP you have to close that down and open up a new account, which is called a RIF.
Right. So you have options. An RRSP you can keep until your 71st year, because it's at the end of that year you need to collapse that account. Yes, you can open a RIF, RIF, or you can purchase an annuity, which is another type of investment that just pays fixed amounts. Now, the thing to know about RIF, or RIF as we call it, they try to emulate an annuity. So there are minimum amounts that you must take out annually. That number changes. It's calculated based on a formula. And there are maximum amounts that you take out. So the key to understand is that maximum. People seem to think, okay, well, it's all my money. I want to buy a big $50,000 boat this year. I'm going to go crazy in my retirement. And you're capped.
Right.
Whatever, it depends on the amount of money you have and the formula for that maximum. But it effectively is sort of a indirect way to have an annuity without purchasing an actual annuity, which is just another type of investment. But yes, at the end of the year, on your 71st birthday, you must collapse that RSP.
Okay, so we have 1 minute left in today's show. What words of wisdom do you have for investors out there when it comes to a type of account, investments, something that they should look out for when they decide that they want to open up an account, something to help guide them?
Sure. I would say a couple of things. Absolutely read all the documents you're given by the broker. I know it's intimidating, there's a lot in there, but as we talked about, all these complex little fees and charges, you need to know. And my other bit of advice is, when you have a plan for this money, it's going to be to buy a house, it's going to be for my retirement, education, whatever it might be, you need to stick to that. You cannot change your plan because, as we just talked about, if you don't use those accounts the way they were designed, there could be a big penalty to you. Those would be my two biggest tips. And the most important is advice. Always get advice. It will cost you a little bit up front to get advice, but boy, will it save you a lot later.
That's great. Thank you so much, Jackie.
You're welcome.
So understanding the tax implications for one account to the next can help you select an account that best suits your personal circumstances and can help you reach your financial goals. Investing on your own can be both intimidating and exciting, but if you're unsure, choose an investment advisor that you feel comfortable with and that understands you and your retirement goals. Remember, ask a lot of questions and surround yourself with knowledgeable individuals that can help you decide which account and investments are the right fit for you. I'd like to thank Jackie Sanz for joining me today and you, our viewers, for watching. For more information about our show and to view past episodes, go to financespersonal.ca. I'm Liz Namofsky. Bye for now.